company Microsoft. I chose Microsoft because they're part of the Dow Jones Industrial Average, which is the top 30 U.S. firms. So it kind of is part of the judgment of how the stock market's doing. Okay, first of all, we're going to look at their liquidity ratios, which is their cash ratio, quick ratio, and current ratio. And your cash ratio is your most liquid, which is your cash over current liabilities. And we can tell that in 2011 it was 1.83, and then it kind of goes up to 2013, which is 2.06, and then it starts going down again in 2015 of 1.94. And your quick ratio is your assets minus your inventory over current liability. And because Microsoft is in the software kind of technology field, they don't have much inventory, so it's not going to be much of a difference from the cash ratio. But your quick ratio is decreasing too. And your current ratio, which is your current assets over your current liabilities, for 2011 it was 2.6, and it goes up in 2013 to 2.71, and then now it's decreasing to 2.5. So overall, looking at their liquidity ratios, they're not looking the best right now because they're decreasing. And then this is it in a graph form, so you can see that it starts to rise, and then it peaks, and then it's starting to go down. And we need to look at their more of the long term, which is their obligations for long-term debt. And for this, we need to look at the equity multiplier, which measures the use of debt to acquire additional assets, which is also your financial leverage. And we want the equity multiplier to be low. And right now, it's rising. In 2011, it was 1.89, and now in 2015, it's 2.05. And you also need to look at your TIR ratio, which is your time to interest earned ratio. And that is if the company has ability to honor their debt, and you want this to be high so you can pay back your shareholders. And we can see that it's dropping too. In 2011, it was 137, and then now in 2015, it's around 30. So that is a big drop. And so this is what it looks like in a graph form. And so your equity multiplier is raising a lot, which is really bad. And then your time to interest earned ratio is dropping a lot, which is bad. So overall, this company isn't looking the best right now. And we also need to look at their profitability ratios, which is ROE and ROA in their makeup. ROE is made up of ROA and your equity multiplier. So for your ROE, we want that to be high, and that is your how much money your shareholders will get. And right now, it's at 14, which it was in 2011 at about 45, so we're dropping fast for your ROE. And your ROA, which is how much assets the management is using to produce a revenue. And that's not looking too good either. It's dropped a lot. And your profit margin, which is about how much per dollar the company keeps and puts back into the company. And you want that to be high as well, and it's dropping too. And your total asset turnover, which is how efficiently the company uses its assets, is dropping as well. So overall, the ROE and ROA is dropping a lot in this company. And we also need to look at the price per earnings ratio, which shows you the market value of this company instead of just the value that's on the financial statements. And the price earnings ratio is 17.4, which is a decent price per earnings ratio. Thank you.